Imagine you could invest in 500 of the most powerful companies on earth. Apple, Microsoft, Amazon, Google, Nvidia, Tesla. Some of the most valuable businesses ever created. But instead of trying to guess which one will win, you simply buy all of them at once. No stock picking, no predictions, no complicated strategies, just owning a tiny piece of the entire economy. That's exactly what the S&P 500 is. And today we're going to break down what actually is the S&P 500, why millions of investors rely on it, why even billionaires recommend it, and whether you should invest in it. There's also one thing that most people completely misunderstand about the S&P 500. Diversification is one of the most important ideas in investing. It simply means you're spreading your money across many investments. Here's why this matters. Imagine you invested all your savings into one company. If that company fails, your investment could drop to zero. But if you own 500 companies, it becomes extremely unlikely that they all collapse at the same time. Some businesses will struggle, some industries will decline, but others will grow. And those growing companies can drive the entire index higher. This is why diversification is often called the only free lunch in investing, because it reduces risk without reducing opportunity. But here's something most beginners don't realize about the S&P 500. Not all companies inside the index are equal. You might assume that all 500 companies affect the index equally, but that's not how that works. S&P 500 is weighted by market value. This means the bigger a company is, the more influence it has on the index. For example, companies like Apple, Microsoft, and Nvidia make up a much larger percentage of the S&P 500. So when those companies rise, the entire index moves upward. But if they fall, the index can drop significantly as well. This means the S&P 500 is heavily influenced by the largest companies in the world. And right now, many of those companies are in technology. So when tech stocks surge, the S&P 500 often surges with them. This also raises an interesting question. Why does the index continue performing well over long periods of time? To understand that, we need to go back to how the index was created. The S&P 500 was created in 1957 by a financial research company called Standard & Poor's. That's where the name S&P comes from. At the time, investors needed a better way to measure the performance of the stock market. There were thousands of companies trading publicly, but no simple way to summarize how the economy was doing overall. So analysts created the list of 500 of the most important publicly traded companies in the United States. This list would act as a snapshot of the economy. If the companies inside the index were growing, it likely meant the economy was expanding. If they were declining, it suggested economic trouble. Over time, this index became one of the most watched financial indicators in the world. Today, trillions of dollars are invested based on the movements of the S&P 500. But there's another reason why the index works so well, and it has to do with how it evolves over time. The companies inside the S&P 500 don't stay the same forever. Weak companies are removed, stronger companies are added. Decades ago, many of the largest companies were completely different from today. Industries evolve, technology changes, new leaders emerge, and the index adjusts to reflect that. This means that investors are constantly holding some of the strongest businesses in the economy without needing to constantly trade or adjust their portfolio. The index essentially updates itself automatically. But the real power of the S&P 500 appears when you look at the long-term growth. One of the biggest reasons investors love the S&P 500 is something called compound growth. Compound growth happens when your investment returns begin generating their own returns. Here's a simple example. Let's say you invest $500 every month into the S&P 500. At first, the growth seems slow. The first few years feel barely noticeable, but over time, something interesting starts to happen. Your investments begin earning returns. Those returns get reinvested, and now your new returns are earning returns too. This may sound a little complicated, but it's super simple. After enough time, this will start to create a powerful snowball effect. Your portfolio starts growing faster and faster, not because you're investing more money, but because your previous gains are working for you. And this is why many long-term investors focus less on the short-term market movements and more on consistent investing over decades. But even though the S&P 500 has historically performed well, it's important to understand that it's not risk-free. The stock market doesn't always move in an upward straight line. There are periods where the market falls dramatically, like very quickly. During the 2008 financial crisis, the S&P 500 dropped more than 50%. During the COVID crash, markets fell rapidly in just weeks. Moments like these can feel terrifying for investors because when markets crash, fear spreads quickly. People panic, headlines become straight negative, and many investors sell their investments at the worst possible time. But historically, every major crash has eventually been followed by a recovery, and investors who stay patient were often rewarded over time. This is why long-term investing requires something more important than intelligence. It requires discipline. Another thing that confuses beginners is how do you even invest in the S&P 500? Because technically, you can't even buy the index itself. Instead, investors use something called index funds or ETFs. These funds are designed to mirror the performance of the S&P 500. All they do is simply purchase the same companies in the same proportions as the index. Some popular examples include VOO, SPY, IVV. When the S&P 500 rises, these funds rise as well. So buying one of these funds, you're effectively buying a tiny piece of the 500 most powerful companies in the world, which leads to an important question. Should everyone invest this way? Note, this video is educational, not financial advice, but for many beginners, the S&P 500 is often considered one of the best places to start in investing because it offers several advantages. It's diversified, it's simple, and it has low fees. Historically, it has delivered some strong long-term returns. You don't need to constantly analyze companies. You don't need to predict which industry will win. You simply invest in the market itself. But there's one final thing investors need to understand, and that's the reason many people still struggle to succeed in investing. The S&P 500 might be one of the most boring investments in the world, but sometimes boring is exactly what builds wealth. Because the biggest mistake many investors make is trying to get rich too quickly. They chase hype, they jump into trends, they buy things that feel exciting, but the investors who quietly build their wealth over decades often follow surprisingly simple strategies. And one of the most famous strategies in modern finance is simply owning the S&P 500.